Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming in and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. If you guys have any questions, before we get started, there are two ways to ask the questions. You can put those in a live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on a show and ask your question live and direct, we also put out a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand. Click on that. You don't have to turn on your video camera, but then you could come on a show and ask your question live and direct. So those are two ways to ask questions. While we're waiting for any questions to come in, I'll start out with the pre-market report, take a look at what's trading in pre-market hours. Yesterday, I didn't get to the options chain. So we're going to talk about the options chain. Robert brought up two features on there that he had a question about, standard deviation and average moves up and down. So I'm going to try to cover that today since we didn't get to it yesterday. And if you have any questions come in, let me know, Will. I'll stop and take those questions.
No questions, but speaking of Robert, he did mention something that I might as well share with the community about the Baltic Dry Index. For those who don't know, that's a Bloomberg rate, cost of basically shipping goods, right? And when we were talking about it a year ago, when those prices were outrageous, right? You heard numbers like $30,000 for a container of goods that used to be, $1,000. Well, that index is in 70, 80%. And Rob was just proposing, just asking a question and, not like you and I know the answer either. But with all these, that index, you look at lumber, you look at oil, all these major input costs have come in significantly since their highs. With interest rates also being raised, what do we look, 6 months, a year out? Have they tagged this inflation and it's starting to really come in? It's an interesting thought. So just thought I'd put it out there. What it's making me think for sure.
Yeah. And I think that definitely helps, right? When you get those prices are coming in, that's going to help the inflation. But I think there are a couple of things right now going on with inflation, certainly with the pandemic, the supply chain issues, which we're talking about, that you just mentioned. The war in the Ukraine is impacting us in a different way as well, because now the benefits of globalization, we're seeing that either peak or start reversing, which was deflationary. And I think that when we had easy money and the supply of money increased, it created a dislocation or imbalances in the labor market. And that's creating either low productivity or negative productivity. And all these are contributing to inflation. So really the supply chain, that's definitely one factor. I think that's looks like it's improving. The globalization, I don't know about that. That we've seen lots of benefits in the long term that I think that have peaked and maybe even starting to see reverse, not only because of the war in Russia, Ukraine, but what's going on now with China and potential issues there. And then the bigger one also, I think, is that we're seeing in the labor market that it's not just tight, but there's low productivity. The companies with easy access to money and I think that they were behaving rationally from the sense that the labor market was very competitive. They were hiring people just in case, you know, they didn't want their competitors hiring talent, so they were hiring talent. It's tax deductible to hire a person, so any profits you're generating, you know, you hire an employee, you're not paying taxes while you're right on the it's a tax deduction. But I think that for the Fed to feel comfortable lowering interest rates aggressively, because right now we're really at neutral, right? We're not, to lower them from here would have to be a good reason. At this point, they're not even tightening. We're at neutral. You would need to see either a deflationary pressures where we have excess inventory, right? So you're going into a recession, you have excess inventory, you need to create demand for them. So that's one way the Fed could feel at ease lowering interest rates, or we see very big productivity gains, right? And so far that seems far away, right? So I'm not, even though prices are coming down, things are still tight, supplies are still tight, even the housing market, they're saying things slowed down, but the housing market, there's not a lot of inventory, right? So there's not like this whole, we're not seeing issues from, a buildup in inventory, excess inventory. We're not seeing those types of pressures right now. And productivity.
Here's something interesting I found out this morning. I knew there were people doing it, but what percent of homes purchased it in the last quarter, and these are single family homes, right?
Yeah.
Were purchased by single individual investors, do you think?
Well, I know it's higher than it wasn't historically, and that's because I think access to easy money, but I don't know what is the percentage. I think it might be high. What is it? Like 30?
I was shocked. They said 25%.
25%. Okay.
I mean, that's an amazing number. And they've been taught, and I've read articles recently. I mean, people in California are buying places in Mississippi. It just seems like something that could backfire. Call me crazy.
Potentially, but they're all being rented out, right? Like there's no issues renting out properties.
I guess.
You're looking at a situation where if people were making investments in single family homes with the intent of renting them out to create cash flow, and they're able to rent them out and create cash flow, I don't think there's an incentive for them to, what's going to make those houses go back on the market, or even to reduce prices. I know some people who are very heavily into real estate. I was talking to them, and they own lots of properties, and the rents are going up, and they have no incentive to sell at all. If anything, they think their properties are going up in value because the rents are going up. So I'm not sure if that's going to create inflationary pressure. What's that, Will?
Well, I think in certain markets, particularly ones where there's short-term rentals, there are all sorts of regulatory issues that are happening, make it potentially harder to rent. I agree with you. If you're in a market with a solid long-term rental market and you can get in and yield, you're probably safe. But the
fundamentals,
it's interesting.
Yeah,
it is interesting. I mean, it limits supplies for people in the area who want to buy homes, right? It puts pressure to the upside.
Look at Manhattan. The rental market. Investors are not going to sell units that they could rent out easily in cash flow. So there. And I think if the fundamentals support it, then those markets will remain tight. But
we did have a question pop up. It's from I'm hoping I pronounced this right, LeBaron. He was asking about. You remember Rob brought up an issue where there was something on I don't know if it was on the op, I forget where it was on the dashboard, but something that Robert mentioned he didn't see on his, and you were going to have the developers add it. Do you know if they added that access to it?
Yeah, that's right here.
All right.
So that's this tab over here, the support and resistance. So these are in the pre-markets. This tab here organizes the bigger block trades and by symbol. So it gives you like a summary by symbol of the block trades. So yeah, we did add it right here.
So everyone should be able to see it now.
Yeah, it should be available right here. So let me go back to the summary page. And all right, so let's go really quickly. We'll take a look at the pre-market report, and then I'll go to the options chain so we could take a look at another feature Rob brought up. So we'll talk about that. But if questions come in, let me know. So pre-market report, these are stocks trading in the pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 116 stocks made our percentage gainers list, 69 on the percentage decliners list. So right now, from that perspective, looks like a more bullish bias at the open. I'm going to filter down this list to just S&P 500 stocks to see what's going on there. This way we'll take out anything from this list that is low cap stocks, ETFs, leverage products, closed-end funds, preferreds. We're going to remove all those just to focus on S&P 500 companies. To do that, I'm going to use this filter up here in ETF. Let's drop it down. I'm going to select SPY, which is the S&P 500 ETF. By selecting that, the list below gets filtered by holdings of the SPY, which are the S&P 500 constituents. So we see here 15 stocks made our percentage gainers list, 7 on the decliners. So from this perspective, looks like it's not a huge list, but still looks like we're setting up for slightly more bullish bias at the open. So if no questions here.
D, special alert. We have a raised hand from our favorite Tesla owners come in. So
awesome. Okay. Yep.
All right, you ready?
Yeah.
All right, Lauren, we're going to allow you to talk. Please turn your mute off. Thanks for joining us, Lauren.
Hi. Hey, Lauren, how are you?
Good morning.
Good morning.
I have a quick question, actually. If you go on the option chain,
okay,
and take an underlying, I took a new month.
So, do you want me to go to a specific symbol?
Well, yes, just to show an example here.
Okay, so I'm on SPY.
I took new months this morning. And NEM.
Oh, NEM. Okay. Okay.
So I look at the strike. Let's go on 21st of October.
October 21st expiration.
Yes. And I use the IV percentiles column a lot.
Okay.
So when you, let's say, take on the put side the 40 strikes, it says 100%.
Mm-hmm.
When you click on, so I love to use this. My question is very, very simple. Do you only look at the I think it's 5.6%. Do you only look at the exact occurrences when the percentage distance of the at the money price, or does it look at, because it doesn't look at every week or every month, correct?
So when with this specific one, it's looking at this particular option. And right, so I think that this one is looking at the particular option, and it's going. Let me take a look here. I'm trying to see if just looking at the call. Let me try to remember how this one works.
Yes.
Yeah, I haven't looked at this one in a while. So I'm looking at it here. So currently this is 38, 30, like say 39. I'm seeing the average, median, low and high. So
I was wondering whether it looks at the price at the money distance you understand what I mean?
right.
The absolute price basically of the volatility, let's say, of the option.
Right. So
because
that's
I use this.
Right. Mm-hmm. So right. So I believe, from I got to go back, and I haven't looked at this in a long time. I'm glad you brought it up. I'll take a look at it. But to me, that's what it looks like, that it's looking at actual observations of puts with 30 days left to expiration. So 38 trading days, right? Like over here. And I think it's looking at strikes that are 5.6%.
So it would then skip the strikes which weren't at 5.6%, I suppose, because I like to play with the timeline also to see in the recent months compared to last year how the IV is, because this is really absolute terms. So this is why I like it.
Right. No, I believe so. It's remember, you're not going to always get exactly 5.6%, so it gives it some room, right? So it might have like a 0.5% around, something like that. I forget what it is exactly, but it gives it close to that, and then it captures the implied volatility. So I believe it looks at that the days, trading days left to expiration, and the distance away from the spot price.
So the difference between this and the IVTO number is this is absolute, and the IVTO takes into consideration movements of the market.
Right. So this one takes the absolutes, right? The actual observation. The IVTO, what it does is it interpolates the curve on a daily basis. So this will have less observations, right? Because you have to wait for an option with exactly 38 days to go that has a strike close to this amount. Then it captures that data point. But obviously you don't have an option every day that's exactly 38 days to go. So, or 5.6% away. So what the IVTO does is it captures the entire options chain daily, and then it interpolates based on, let's say you have 35 days to go, right? Well, there's no 35 days to go on this options chain. So take the two expirations that straddle 35 days. It calculates the implied volatility curve, right? So it goes through, looks at all the observations that it has and creates a smooth implied volatility curve, and then takes the weighted average of the expirations, right? The weighted average moving between expirations and the curve, right? So the weighted average of those are then interpreted.
So the IVTO would, in fact, would be like the same but smoothened because it's a rolling theoretical value, because this one says 100%, or let's say at the money it says 85%.
Right. So that would be
if you would if you would sell this, say would sell this or buy this put, what would the IVTO say, and what would be the difference in interpretation?
Right. So the IVTO tries to actually capture a daily, right? So this is, you could see here, it's a daily observation interpolated from the options chain. So very similar to IV30, right? So the implied volatility, IV30, right? That just like the VIX, right? The VIX is also a 30-day constant maturity. But we know that there is no option that's exactly 30-day constant, 30-day maturity every single day, right? So the VIX exists every day, but there is no SPX 30-day maturity every single day because they list new options, they expire. So it's a formula to say this based on the observations surrounding it using the weighted averages. It's a methodology, right? So you're sticking to
I understand.
methodology.
So,
Right.
this
you
IV
interpolate.
percentile on the option chain would be comparable to IVTO. IVTO does not take stock movement into consideration. Does it only?
No, IVTO does look at the skew, right? So it's looking at percent away from spot, days to expiration. It does do that, but it's not. It's not looking at, okay, so this one here,
Yes,
it's only capturing when an options chain is exactly 38 days left.
Yes.
Right. That's it. So maybe it has 5 observations, right?
Yes.
Like over time. This down here is saying, okay, I recognize that there isn't an expiration exactly 38 days away, but I do see options surrounding it that I could make an interpretation that if there was, right, this is the most likely implied volatility, it would be based on all the surrounding information.
I understand. But so it doesn't take the underlying movement into consideration. IVTO looks only options against option.
I mean, I'm not sure I understand that question.
The IV percentile on the option chain looks at when there was a similar situation with a similar amount of days and a similar distance from the underlying from the stock price.
Yes.
And how many occurrences there were. Maybe there were a small amount. It doesn't matter, and it shows you this one is expensive, right?
Right.
And the IVTO smooths it out.
Yes.
But does it compare option prices with option prices, or does it also compare how the movement of the underlying has influence? Does it take the movement of the underlying into consideration, IVTO, like because it went up 5%, the theoretical value of the option would have been X?
Well, it's always looking at what would an option that is this distance away, right? So it's looking at the movement. So if the stock, let's say, moved up 10%, right? Historically, it was always looking at the option from wherever the stock price was, let's say 6% lower, right? So it's always looking at that. Like, what is an option that's 6% below spot price? Right. So that's how it looks, because the stock is moving around, right? So if the stock's moving around, the distance, the strikes, the distance of the strikes are changing from the spot price. So you're always updating that. Well, what is the strike, that's 6% away today, right? So if the stock is 100, right, then the strike price is 6% below 100, 94. If the stock's 200, then 6% below is,
because there are some big differences between the IV percentile on the option chain and the IVTO.
Yeah, I would expect it, right? Because it's a completely different methodology. You're probably looking at 5 actual observations, maybe versus 30 interpolated, right? So these will have, 191 observations. Right?
So you would always use the TO value to have an assessment.
I would, because it smooths it out, right? It smooths it out. It lets me look at the most recent, like, well, this is how it would have been priced.
Yes.
Based on the recent volatility. So I could see how it's been moving. So I could see it's been moving higher.
Okay.
Right. So kind of been edging up, but and we show both, right?
Yes.
That you could reference both. So there's a reason we show you as much as we can, so you could compare it. But here I'm also changing it because I could, with more observations, I could look at different scenarios. So here it's on a dynamic IV range. So it's looking at, well, are the implied volatilities on the high end or lower end? And then it's filtering out for that. So if I take all observations, where I say, I don't care if implied volatility was high, low, medium, just show me all. I could rerun it, right? So,
I see. Yes.
so it gave
And
me
this
more observation.
this would show you closer to the absolute value that is shown on the option chain.
Well, not necessarily the absolute values that's not right. That's more of like,
Yes.
that's right. There's less of those observations, but
Yes.
that was the actual one at the end of the day. This one is more of a smoothed out derived value.
I understand. Thank you. Okay. Okay, that's perfect. Thank you very much.
Yeah, no problem. Thanks. Thank you for the question.
Hey, great job, Lauren. Thanks so much, buddy.
Bye-bye.
Bye.
So
All right.
yeah, that was a good question. I forgot.
That was a good question. And I'm going to follow up with a question from Rob, since we only got about 4 minutes left. I guess we can save what you were going to talk about today to tomorrow.
Okay.
But Rob is asking, is the IV Theo part of the trading card ideas? That's his question. And then he asks again, is it relating to Edge?
Yeah, so the trading cards here do not look at the IV Theos. There are different ways to calculate an estimated value of an option. So there's no one methodology. There's no one way. You have the option pricing model, but in the option pricing model, you're putting in different assumptions. You could use volatility inputs. And the trade cards here, the fair value here, oh, sorry, on the wrong one. The trade ideas here, they're using an estimated value based on historical return distributions of the stock. So looking at the actual stock returns under similar circumstances. So if there's 10 days to go till expiration, if let's say there are no earnings coming up and implied volatility is at its high, it goes in history and says, well, how did the stock perform during those periods? And based on that performance, what do we think the average value of this particular option would be? So it's not looking at implied volatilities, it's looking at actual historical stock return distributions, right? So how did the stock tend to behave? That's how these trade card Theos. The implied volatility Theo is looking at something different and saying that with these amount of days to go, with X amount of days to go, right? And with, similar circumstances, IV Theo elevated, let's say there's no earnings coming up, October 21st, it then goes back in history and says, how was the average implied volatility of an option, right? So this isn't based on historical returns of the stock over 38-day period. It's just saying, how were these options usually priced? Given similar circumstances, how was an option of, 12.1% above the spot price, 38 days to go? What was it usually priced in the market? So we look at the historical snapshot observations, convert them to IVs, and then take the average. So that's the different methodologies. You could input your own IV as well if you wanted to, but using the Black-Scholes. So you could, if you already wanted to input your own IV, you could use the option pricing model and say, well, I think IV should be, 38. Could input that in there. And then you could run IV Theos, and this generates a theoretical value in the middle, right? It's just different ways to assess the value of an option. Kind of like really quickly, if I was going to assess what do I think a house is worth, right? I could look at recent sales and take the average. I could look how much would it cost me to replace the house, build a new one, or I could look at the rents and say, well, based on this rent, and I need to earn 10%, I think it's exit. So there are different methodologies that you could use to create a valuation. And that's So that's the ones we talked about today. One is looking at historical IVs. We can look at historical stock return distributions, input our own volatility into the option pricing model. So those are the kind of like three we just talked about.
Awesome job, Dima. Laurent, way to bring a great question live. Always makes for a great show. We recommend everyone do that every day. We really blast the show into the stratosphere, I think. D, great job as always, my friend.
Great. Thanks everyone for joining. Stay safe out there. Have a great trading day. And tomorrow we'll talk about these. So we talked about the standard deviation, average up move, average down move. So we'll discuss the difference between these two.
Perfect. Can't wait for that. Okay. All right. Have a great day, D. Have a great day, Chameleons. Trade in peace, everyone. Bye-bye.
Listen, thanks, everyone.